people are looking at it from more of a strategic lens versus an instant monetary lens. Yes, you could take 20, 30, 40K currently right now if you sell, and you're going to get buyers, but what is your long-term play?
Ray is the Director of Strategic Accounts and Kiavi, formerly known as Lending Home. He provides financing, data mining, and technology resources to help real estate investors make better business decisions. So thank you so much for joining us this morning.
My pleasure. I couldn't have said that any better.
Good seeing you, Ray. It's been a while.
It has been a while since I was in your office many, many years ago.
Yeah. So, glad we can chat. I always love asking this question to lenders or folks that work in the mortgage space, specifically in your case, working with investors, because that's your company's niche, because you've got a good pulse on the market. You're talking with a lot of different operators in different markets doing different things. So with your pulse on the market, what are you thinking real estate's going to look like in 2022?
I think it's going to look a lot like what it did in 2021, but better. I think, you were on just before with Jason and talking about the inventory problem that won't get cured in 2022. So, I spend, as someone in business development, all I want to do is listen to what customers are experiencing so that we're kind of out in front of, issues. And so as 2021 went into this year, we're going to 2022 here in less than a month. I think there's a better playbook for folks as it relates to properties that they're taking down. There's a higher level of confidence as it relates to exits. I think interest rates, at least on the consumer side, will continue to be at bay. There's always I think a little bit of force on interest rates to go up, but I truly believe, both myself and what I hear on the consumer side, right? This is not on the business purpose side, investment side, et cetera, that those interest rates will, for the most part, stay at levels that they're currently at. And that's a lot of it's going to be driven by the fact that, employment and income are not keeping pace, right? It's not like all of a sudden people are making 50K more per year these days. Inventory isn't being cured. And as you see almost every single time that interest rates start to ratchet up a bit, there's like a fury, right, from a consumer standpoint. And then all of a sudden they dip back down. So I think from a confidence standpoint, that's going to stay about the same. We have 4 kids and 3 of them are probably in that possible home buying mode here in the next year or so. It would be interesting to see how conventional mortgage lenders start to expand the box once refinances start to dissipate, right? And so, will a 40-year AM or a 50-year AM come around sometime next year versus going down the path of maybe credit softening? Because you had mentioned, 06, 07, 08, which I was in the mortgage industry at that time. And that's what took place, right? That's what caused much of that credit crash. Whereas if the amortizations just went out and the rigor that already exists today on the conventional side stays the same, I think that's potentially a way of being able to address more homeowners as prices start to, continue to tick up. But I think 2022, both, as Kiavi funding provides residential financing for both short-term and long-term financing. We feel that market's going to be extremely strong, with maybe a possibility of interest rate pressure toward the end of the year. But we're not hearing a lot of that pressure being in Q1, 2, or 3.
Yeah, I mean, everything I've heard is if we see anything, it'll be 1 or 2 rate hikes, which is which will be minimal. But it's almost like it's a very complex problem. We have all these issues with supply being one of the major problems of it. You mentioned the delta, the difference now between rate of growth of home prices and of wages. The one thing that's helped that is just historically low interest rates.
Right.
But as that ticks up, every quarter point, half a point, eighth a point, whatever, that eats into that affordability that's already a problem. So yeah, if it does go up, it creates an affordability, it expounds the affordability problem that we already have.
Correct.
I'm not really sure what that looks like, but for investors, because you deal with not necessarily, I don't know if coaching is the right word, but definitely providing strategic advice for investors, especially in relation to the products that you offer.
Right.
What conversations are you having with investors out there that are, they're actively acquiring deals?
That's a good question. So what I try to pass along is I speak almost exclusively, not 100%, but almost exclusively with a lot of experienced operators, right? Folks that are earnestly, investing in real estate, whether they're keeping rentals, whether they're doing flips, whether they're doing both, et cetera. And the constant feedback that they share with me, that I share with newer investors, is kind of know your numbers and stick to them, right? So don't go chasing, these increases in prices and think that you can sort of make up for it on the back, because that ends up, if you're a newer investor, you just don't have the staying power. You probably don't have the capital to really overcome one or maybe two of those purchasing mistakes,
which is hard to do in a low supply market.
It is,
because
it is
stretching. I mean, we found ourselves doing that in 2019, and it's part of the reason why we just switched to buy and hold. It's just so much simpler when you hold it long term.
Yeah, and I'm seeing a more of a shift in that, and it's a decision operators have to make, because the short term money's still there, right? So if you sell these properties, you could still make money, but I think people are looking at it from more of a strategic lens versus a monetary lens, right? An instant monetary lens. And so, yes, you could take 20, 30, 40K currently right now if you sell, and you're going to get buyers, but what is your long-term play? And so there's a couple of, certainly if you're a newer investor, I think you have to make money. And so a lot of times it's done through an exit through sale, but I'm noticing, I think people accelerating their adding rentals to their business plan sooner than later. And most of it's just because they feel that the acquisition prices are getting out of hand, and they need to accelerate that by keeping these properties. You can always sell. And I agree with what you said with Jason, that we're not anticipating a massive value crash, right? Like we once had. I mean, I think inventory has to almost overcorrect, and it's not even coming close to correcting.
Yeah, that's going to take time.
Yep. Yeah.
How can folks reach out to you and your company?
Well, the easiest way is my email is ray@kiavi, spelled KIAVI.com. So that was one of the benefits of our rebrand, is our my email address got shorter. But that way I can kind of correspond with them. I can connect them maybe with the right team member if they actually have some properties that they need to finance, et cetera. But from an education standpoint, it's always better to start with the folks in new business like myself.
Yeah, and I've always had a great relationship. I don't think I've ever worked with you on short term, but I've done long term several times. And I think we actually just sold the most recent one. So had a great experience. Yeah, definitely.
Appreciate it.
So thanks for being on.
Okay, thanks for having me, guys.